Hi, I'm Jim Smith.
And I'm Martin Fox. Welcome to our third investment update for 2024. Jim, take us through the headlines.
Thank you, Martin. For the 3 months ending 30 September 2024, we've seen continued gains across global markets, with New Zealand in particular having a good quarter. In the US, the Federal Reserve kicked off their interest rate reduction cycle with a 0.5% cut, leaving their interest rate target at 4.75 to 5%, with the prospect of more rate reductions to come. Here in New Zealand, in response to a tough domestic economy, the Reserve Bank surprised economists with a 0.25% cut in August, which has now been followed up by a 0.5% cut in early October. If we now look a bit more closely at interest rates and inflation, following the succession of steep rises in interest rates that started in early 2022, the New Zealand official cash rate remained at 5.5% for 15 months, before being reduced by a total of 0.75% to 4.75%, with further cuts likely. This has been made possible by falling inflation, which at the last reading was 3.3%. This is still 1.3% higher than the 2% target, so the Reserve Bank must be confident that inflation is going to fall further in the months ahead and can therefore provide a much needed boost to support the flagging economy. If we now look at the New Zealand dollar compared to some key foreign currencies, against the US we can see the New Zealand dollar has been relatively weak since 2022 and has been trading in a narrow range compared to its 10-year average. Against the British pound, after gaining ground in 2016, the New Zealand dollar has been steadily losing value and is now sitting close to its 10-year low. Compared to the Australian dollar, the New Zealand dollar looks slightly weak again, but is more in line with its normal range.
Looking now at market returns. For the past 12 months to the end of September 2024, global share markets performed strongly. In New Zealand dollar terms, the S&P 500 index, which represents the 500 largest companies in the US, was up over 28%. Australian shares have also had a good year and were up around 23%. The MSCI World ex-US Index, which is a broader measure of stock market performance of companies outside the US, rose 18%. Here in New Zealand, the stock market rose 10%. New Zealand bonds also produced a similar return, buoyed by the recent cuts in interest rates. If we now look at the last 3 years to the end of September 2024, we can see global markets still performing strongly. But here in New Zealand, stock and bond markets both struggled. Taking a 10-year view, we can see New Zealand shares doing much better. The US still leads the pack with a gain of over 15% per annum, and the New Zealand market up 10% per annum, beating both the Australian market, which gained 8.6% per annum, and other global share markets outside the US, which gained 7.4% per annum.
On the back of some better returns for New Zealand shares, we thought we'd take a closer look at the domestic market. The top 10 companies by market size is shown here. Fisher & Paykel Healthcare remains New Zealand's largest company, with a market capitalisation of around 20 billion New Zealand dollars. This is followed by Meridian Energy, Auckland International Airport, Infratil and Mercury, which round out the top 5 companies by size.
New Zealand companies have historically paid higher dividends than many global companies, which is attractive to investors seeking a higher yield. However, the market is one of the most concentrated, with the top 10 companies making up over 64% of the NZX 50.
So with markets stable despite the Middle East conflict and the continuing Ukraine-Russia war, what are the key takeaways for investors?
Markets have still delivered a year of sound returns despite some unsettling headlines and a US election that looks like it'll go down to the wire.
And while some markets like the US have done better than others, markets are very competitive, and we shouldn't assume that history will always repeat. It is therefore important to select a well-diversified portfolio, holding investments across many countries, regions and asset classes.
Investors should also review their situation at least annually, so together with your advisor we can make any necessary changes to your investments as your situation evolves to keep you on track to achieving your objectives.
Thank you for watching. As always, if you have any questions, please reach out and we'll be happy to help.